of Unfuck the Poor, and we have covered a lot so far. Definitions, racism, redlining, predatory subprime mortgages, the financial crash of 2008, and the assholes who for some reason didn't give a shit about it. If this is the first episode you're listening to because the title has a funny name, I don't blame you. GooeyPooey69 is a ridiculous name, but the story behind it is even more ridiculous, and it's hard to believe that grown-ass men actually spent time typing it out, but whatever. If this is your first episode with us, let me just tell you there is a lot more content on our parent website, askaleftist.com, including show notes, links to references and supplemental media, and if you're curious, meaningful essays on global issues. You can also find the full PDF of Unfuck the Poor at the website as well, free of charge. No sign up, no exchange of information, it's just there. Side note, the book you read may not be the exact book you hear. I take some editorial liberties with the book because if you've ever listened to an audiobook, it kind of boggles the mind how the narrator just keeps all her comments to herself. I don't even know how to introduce this fucking chapter, so GooeyPooey69.
Wife of Treasury Secretary Steve Mnuchin, who traveled with the Treasury Secretary to Kentucky, was photographed. He's posted on Instagram here coming out of the plane. In her initial Instagram post, she hashtagged like every brand that she was wearing, including, and I'm not going to say this right, the Hermes. Thank you. David Drucker, I'm impressed by you on that. But then it led to this exchange where someone criticized her, and then Louise Linton, Steve Mnuchin's wife, lashed out hardcore at the person who criticized her, saying, "Adorable, do you think the U.S. government paid for our honeymoon or personal travel? Have you given more to the economy than me and my husband, either as an individual earner in taxes or in self-sacrifice to your country? I'm pretty sure we paid more taxes toward our day trip than you did." April, you laughed first on this, so this is your problem to deal with right now.
Why is it my problem? Come on now, John.
This is a tough look. This is a tough look for anyone connected to the administration
First
to basically
all,
be saying, go ahead.
I looked at those hashtags, Hermes, Ford, Valentino. And
all good stuff, by the way.
Very good stuff. And she had a Birkin bag, I think it's at least $10,000. So when you are a public servant, and even if you're married to a public servant, you have to remember, service is about the people. And many of the people that you're serving cannot afford a Birkin bag that's at least $10,000. Birkin bag that's at least $10,000. So when you are a public servant, and even if you're married to a public servant, you have to remember, service is about the people. And many of the people that you're serving cannot afford a Birkin bag that's at least $10,000.
Unfuck the Poor, Chapter 4, GooeyPooey69. Steve Mnuchin's position as Secretary of the Treasury during a once-in-a-century pandemic was, in a word, fucked. Mnuchin was qualified for his position thanks to his private sector career as a filmmaker, he was a producer, and investment banker. If you like the X-Men franchise, Mad Max Fury Road, and the Lego Movie, you have Mnuchin's Dune and Rat Pack Dune ventures to thank. If you like foreclosures, then you'll love Mnuchin. I know. It's going to be really hard to enjoy the Lego Movie from here on out. In the financial sector, Mnuchin was a Goldman Sachs partner managing, collateralized debt obligations and credit default swaps. A credit default swap is a derivative that allows an investor to offset the risk of default on something like mortgage-backed securities with another investment. It's like insurance. The terms don't mean anything but are confusing, and when there's a, quote, crash, like a car crash or a market crash, the insurance company pays for an uncrashed car to replace the crashed one. If the insurance company goes broke because everyone everywhere crashes their car all at once, then you're screwed. Anyway, Mnuchin was at Goldman Sachs for 17 years, got into some credit swaps and CDOs, then joined a ragtag team of investors including George Soros, the guy at the center of all conservative global conspiracy theories, and John Paulson. We remember him from Paulson & Co. Anyway, they all went in together on the failing mortgage lender Indy Mac in 2009. They purchased its assets and renamed it OneWest, where Mnuchin spent 6 years as CEO and chairman in Southern California, and let's see, according to Bloomberg, HuffPost, Vanity Fair, Truthout, ABC News, The Hill, The Nation, Counterpunch, Newsweek, Nation of Change, and like a couple others, foreclosed on 36,000 homes. That's the number cited. The California Department of Justice counted 35,023. I mean, Mnuchin didn't personally go out and post an eviction notice on Rose Goodiel's Pasadena home, but I'll be damned if that didn't inspire a group of protesters to march in front of Mnuchin's 20,000 square foot Bel Air home in 2011. Mnuchin had a partner, and this name will be important, Joseph Otting, who also served as CEO, you can have more than one, at OneWest, as well as president and board member. OneWest was subject to audit by the FDIC after a group of OneWest whistleblowers claimed OneWest had directed them to reject as many loan modifications as possible. Loan modification. When a borrower cannot meet payment obligations, a modification to loan terms can be arranged, reducing monthly payments, extending payment terms, and possibly refinancing. OneWest employees claimed in a January 10, 2011 letter addressed to former FDIC Chairman Sheila Bair that cranking out foreclosures was due to a financial incentive. The FDIC made reimbursements to OneWest when loans defaulted. The FDIC Office of the Inspector General found no such scheme, saying in a 2011 executive summary that after reviewing 260 loans, there was no wrongdoing on OneWest's part. OneWest had paid $4.7 billion for IndyMac's assets, and per the FDIC compensation rules, $2.5 billion in losses would have to be incurred before the FDIC forked over any money. One could argue that cranking out foreclosures would certainly speed up reaching the $2.5 billion loss that OneWest had to meet for FDIC reimbursement. So if you're measuring progress instead of intent, and if you're measuring progress based on 260 random documents, then your skills as an auditor would be, in a word, subprime. Our justice system does, after all, convict for intent to distribute drugs and conspiracy to commit crimes. Of course, the letter from the Office of the Inspector General is not very specific. It does not include any pertinent information about the OneWest documents, and in fact says that they will not release them to the public. Also, and this last bit is more of a side note, hardly worth mentioning really, but the FDIC did actually wind up reimbursing OneWest $1.02 billion, and they estimated that the FDIC would pay out another $1.4 billion by 2019. Now, to understand all the layers of fuckery here, we have to understand the FDIC compensation rules. Because IndyMac went belly up, it was the third largest bank failure of all time, the FDIC, which insures money, had to step in to prevent everyone with money in or out of the bank from going broke. That'd be fucking nuts. The FDIC can handle this in a few ways. I won't explain all of them to you because I don't hate you, but they are open bank assistance, conservatorship or bridge bank, liquidation or purchase and assumption, P&A. P&A is important here because OneWest is the bank that came in to both purchase IndyMac's assets and assume its debts, purchase and assumption. The failing bank is hemorrhaging money, and the purchasing bank doesn't also want to go under. So the FDIC must compensate the buyer through subsidies or through a shared loss agreement in which the FDIC absorbs a portion of losses on a specific set of assets. That's a whole lot of words, but what it boils down to in the case of OneWest, the FDIC shared the losses on subprime loans, and it reimbursed OneWest when it reached their shared loss threshold, which is some percentage of something. So the FDIC's findings that OneWest did no wrong are in stark contrast with a 2011 investigation performed by the California Department of Justice Consumer Law Section. Hampered by their inability to subpoena OneWest, deputy attorneys general in the Consumer Law Section were only able to review public land records, a few hundred incomplete loan files, and documents from foreclosure trustees. Since March 2009, OneWest had foreclosed on 35,000 homes and initiated the foreclosure process on another 45,000. The deputy attorneys uncovered evidence of widespread misconduct, including OneWest signing of false and backdated instruments and failing to comply with foreclosure document execution, timing, and mailing. A subpoena is an order given by a government agency to an individual or corporation to provide testimony or evidence. Let's use it in a sentence. It looks like you're engaging in financial crimes. Please see this subpoena for bank statements. Thank you, but no thank you. I have preemptive protection. Gah! Foiled again! And in legal terms, an instrument is a formal document that expresses a legally enforceable act, process, duty, obligation, or right. Certificates, deeds, bonds, contracts, wills, etc. are all different types of legal instruments. They are different from financial instruments, but not by much. They're a thing on paper that means something else that are another thing. It's a whole thing. The Consumer Law section's request for authorization document describes some real-world applications of some definitions and terms we've already discussed, so let's just see how horrifying they are. Quote, as part of the acquisitions, OneWest obtained the servicing and or beneficial rights to tens of thousands of troubled loans throughout California. Option adjustable rate mortgages allowed borrowers the option of making a minimum payment, an interest-only payment, or a payment of the interest and some of the principal balance. In 2006, 75% of IndyMax option arm borrowers made only the minimum payment, and because the minimum payment did not cover the interest for the month, negative amortization occurred, i.e. the payment did not cover the interest charged for the month and the payment was added to the principal balance. After a few years, the monthly payment ballooned substantially and became unaffordable. When the homeowners could no longer make their payments, the loans entered the foreclosure process. End quote. Well, and now we have to define a new word, amortization. Spreading out loan payments over time, the word amortize literally means to kill it off. Because a mortgage or death note is structured so that you pay off the interest and the principal balance, the amount of money that you initially borrowed, negative amortization as described means that the principal balance increases. Because you're only making partial payments, the remainder gets tacked onto the principal, which is still subject to interest rate changes because it's an adjustable rate mortgage. You pay less now, but you can wind up paying a lot more later, and then the bank comes up and pops a balloon in your face. Perhaps the best part about the Consumer Law section's research is a little table they provided to show how many documents they reviewed and how many of those documents were backdated. Now, backdating is illegal without two-party signatory consent, and if not illegal, it is grounds for breach of contract. Thank you, contract law. It means that after a document is signed, an earlier date is then recorded, not the date of signature. I'm sure you can see why this would be problematic. Say you signed a piece of paper that said you would make a payment within 30 days, but then it was backdated 90 days in the past. You would appear to be breaking your written agreement even though you literally just fucking signed it. In the handy little table, the Consumer Law section reviewed a total of 913 documents and found 909 of them to be backdated. Now, I know we just went over this, but do you recall that the FDIC Office of the Inspector General sampled 260 random OneWest documents and found nothing suggestive of fraud? The Consumer Law section deputy attorneys even broke down the tables. Out of 640 documents from June 2009, 637 were backdated. Out of 116 from July, 115 were backdated. And from October 2009, 157 out of 157 documents were backdated. That is a rate of 99.56%. For argument's sake, let's just say that since the deputy attorneys could only review whatever they could get their hands on, their sample size was also random, but much larger and therefore more representative of OneWest activities. Fuck it, let's do more crime. The Consumer Law section also reviewed the number of unlawful credit bids and substitutions of trustee. All right, well, shit, now we have to define more stuff. Credit bid. When a home is foreclosed, it is then sold at auction. The bank can make a bid on the home using the debt from the mortgage as a bid. Once the home is secured through the credit bid, it is said to become real estate owned, REO. Hey, all right, we know that term. Substitution of trustee. You buy a house with a loan, the lender or loan servicer is the trustee. If you default on your loan, the trustee can say fuck it and substitute another trustee to handle the foreclosure process. If you get a trustee substitution notice in the mail, you're being foreclosed on, sorry. Fun fact, on the cover of the California DOJ request for authorization to file action against OneWest Bank, there is a handy note from the Office of the California Attorney General that says, quote, case not filed despite strong recommendations, end quote. Not to be a wet blanket, but Kamala Harris served as Attorney General of California from 2011 to 2017. She was also the only 2016 Senate Democratic nominee to receive a campaign donation from fucking Steve Mnuchin. In Harris's defense, OneWest was able to avoid subpoena thanks to the efforts of the federal government like John Jerry Hawk's Office of the Comptroller of the Currency, who, if you remember, chucked preemption at state attorneys general like it was a steaming ball of pig shit, and this was all backed up by the Supreme Court, but by none other than Ruth Bader Ginsburg herself. Of course, not in Harris's defense, I refer you to the fact that she got a fucking campaign contribution from Steve Mnuchin. And just in case you forgot,
the OCC is fully prepared to use its authority to combat abusive, unfair, and deceptive lending practices if they're engaged in by national banks.
Of course, in order for the OCC to review evidence of abusive, unfair, and deceptive lending practices, the Attorney General would have to file action and actually get involved. Is any of this still a fun fact? So, that's what Mnuchin was up to before becoming Secretary of the Treasury, initiating or executing 80,000 foreclosures, most of which were likely illegal, and weaseling out from under California's subpoena powers. Well, that and the Lego movie. He was also busy with that. Since the Treasury Secretary is literally one of the most important members of the presidential cabinet, the group of most important positions would also include the Secretaries of State and Defense as well as the U.S. Attorney General. It is subject to confirmation hearings aimed to vet a candidate's qualifications, experience, as well as their general character. The Secretary's duties are multifold. They formulate and recommend national and international financial, economic, and tax policies, manage the public debt, and create broad fiscal policies that directly affect the economy. It is an immensely consequential role, ostensibly best served by an individual with a deep knowledge and understanding of economic principles and their far-reaching effects. The Secretary position would, and this is saying a lot coming from me, be most effective if filled by an economist. Oh, I almost forgot. Mnuchin has a, bachelor's degree in economics, so obviously the vetting process was a mere formality. Okay, but not to worry, because Mnuchin really deep down has a heart of gold. His is a rags to riches story, one in which a boy from humble beginnings worked hard, beat all expectations to attend Yale, and overcame generations of family struggles, cementing his I am just fucking with you. Mnuchin's father was also a partner at Goldman Sachs, and his great-grandfather was a diamond dealer and founder of a yacht club. The fictional story I just told about, him beating the odds, that actually describes the man Mnuchin replaced at Goldman Sachs, Kevin Ingram, whom at least one colleague described as both more intelligent and accomplished than Mnuchin. Out with the meritocracy and in with whatever you call it when someone dumber and less effective at their job replaces a competent person. The tale of OneWest isn't over yet. In spite of its $2.5 billion in losses, which were reimbursed by the FDIC, OneWest was still an attractive company for huge banks looking to acquire large banks, so Mnuchin shopped it around, eventually enticing CIT Group Inc. to bid $3.4 billion for its purchase, and CIT announced the merger in July 2014. Now, remember that guy I told you, remember Joseph Otting? Joseph Otting was CEO of OneWest, so the two banks began a merger with Otting being the recipient of the offer letter. Everything was going great. CIT completed its acquisition of OneWest in August 2015, turning Otting into president of CIT and co-president of CIT Group. He had a buff salary and $24 million golden parachute. Fuck. We forgot about the Community Reinvestment Act, or CRA. Now, during bank mergers, the CRA becomes crucial in ensuring that the resulting much larger bank commits to serving low and moderate income communities, which are arguably low and moderate income as a result of multiple generations being denied access to bank credit due to redlining. The Community Reinvestment Act, or CRA, requires that banks that receive deposits also meet all the credit needs of the communities where they take deposits. That's the short of it, at least. And it makes sense when you think about it for a couple of seconds. And then when you think about it longer, you'd be like, well, wait, banks aren't already required to do that? The California Reinvestment Coalition would like to have a word with you because no, banks are not required to do that. In spite of mountains of evidence that redlining was indeed a racial practice by real estate agents on behalf of the U.S. government, modern banks don't see it that way. Modern banks see it like this. We moved into this neighborhood and there are all these fucking poor people and we can't possibly meet their needs because we won't make money, and that is the short of that. But the CRA does something else, something incredibly sneaky and, dare I say it, conservative. By putting the onus on banks to provide community investment, the communities are therefore less reliant on tax dollars and the government in general because, let's face it, expecting tax money for community investment is, as of this writing, a whisper of a dream that died long ago. Not gonna fucking happen. As a result of the CRA, an estimated $6 trillion has been invested in these low and moderate income communities. Naturally, Joseph Otting hates this for whatever reason, who the fuck knows. And the California Reinvestment Coalition hates Joseph Otting. It's a match made in heaven. Anyway, after CIT announced the merger in July 2014, the CRC filed an objection to the merger on CRA grounds and demanded a public hearing, which does not happen with every merger, but this is how the CRA works, so it's not unheard of. A bank comes in all willy-nilly, groups such as the CRC or Acorn say, hey, this is a low-income community, you're required to comply with CRA, so let's work it out. Now, they also go through this process when banks open new branches and during CRA examinations of bank performance. It's actually a whole ass thing, this CRA. So on December 16, 2014, the CRC announced that the very next day, December 17, they would rally in front of OneWest headquarters and call on regulators to hold public hearings on the merger, and because the California Reinvestment Coalition doesn't fuck around, they were going to urge bank leadership, Joseph Otting, to put a moratorium on foreclosing on widowed homeowners. And yes, they were that specific. And Joseph Otting hates it so much. Otting hates all of this. He hates the idea of a public hearing. He hates the idea of a demonstration led by CRC. He presumably hates the widows that he's foreclosing on. He hates all of this so much that following the CRC demonstration and demand for a hearing, he solicits letters of recommendation from the most esteemed of his colleagues in banking and finance and asks them to be sent to the Federal Reserve, or the Fed. Just kidding. Okay, what Otting did was he got himself involved in what I will happily call the GooeyPooey69 scandal, and of this, I shit you not. GooeyPooey69 at yahoo.com was one of 2,093 fake emails sent to the Fed supporting CIT's merger with OneWest. See, when Otting requested these letters of recommendation, what he was really doing was asking these people to send emails to the Fed supporting this gigantic-ass merger to prove to the Fed that all these assholes from the CRC were fucking wrong. The community loves this merger. It's a great thing. So anyway, when GooeyPooey69 was emailed, it bounced back, meaning that the email address was fake. But not all the emails sent to the Fed were fake. The emails were fake, but not the email addresses. You see, back in late 2014, Yahoo.com was hacked, and the accounts of some 500 million users had their data stolen. Let's go back. 500 million, 500 million users. Basically everything you'd include in a user profile or email account, passwords, addresses, phone numbers, birth dates, all the stuff you trust is protected behind a wall of complex whatever the fuck encryption is. Yahoo suffered 2 such hacks, nearly back to back, one in 2013 and one in 2014. One was by an unauthorized third party, and the one in 2014 was by a, quote, state-sponsored actor. All right, so here's a fun game. Do you want to guess where all the emails sent to the Fed on behalf of the CIT merger came from? Hint, they all ended in at yahoo.com, including GooeyPooey69. If I had to guess, this was at one time a real email address, but the user turned 16 and the novelty had worn off and the account just kind of withered and died in the internet wasteland. That's one theory. But I also like imagining Joseph Otting sitting back at his desk with his face wrinkled in serious contemplation while looking at a blank Yahoo sign-up page, trying to come up with the perfect email address that says both, 1, they'll never suspect it is I, the CEO of OneWest, and 2, I am fucking baked. Anyway, here's what the emails said, every single one of them. Quote, Dear Chair Yellen, President Dudley, and Comptroller Curry, I am writing to offer my support for the pending OneWest and CIT merger. OneWest serves as a strong source of capital and banking services to the Southern California community. This merger will retain and create new jobs in California. I believe the management team in OneWest have demonstrated its commitment to our community and to serving the needs of not only their clients, but the community at large, and due to this, I do not believe there is a need for a public hearing. That's what the emails say, all of them, over and over and over. Among some of the replies from the real email address owners, quote, I never send this email. I am not aware of the merge of the companies. Someone got a hold of my email address. Sorry. Quote, I did not write this letter. Quote, I am not the writer of the communication below. Name, address, and zip are wrong. Quote, Mr. David Finnegan, OCC, this is to bring to your attention that I received an email from the Office of OCC regarding a subject I am completely unaware of. I did not send the email below that you responded to. This is a fraudulent use of my email account. I will be working with my email hosting provider to ensure that this does not happen again. And another thing. Most of these emails share very similar timestamps and dates. February 14, 2015 at 4:35 a.m., February 14 at 4:36 a.m., January 16 at 11:42 a.m., January 16 at 12:13 p.m., like someone is just clicking send one after the other on these 2,000-something emails. These dates are repeated so often, I actually thought that I was reading the same email, like I was just repeating the same line over and over and over as I was reviewing this. I had to verify the reply times from the OCC verification account to make sure that I wasn't just rereading the same thing. Of course, none of this shit really matters because the merger went through, and by December 2015, Joseph Otting was just fucking fired. Joseph Otting, aka GooeyPooey, retired to Las Vegas where he co-managed Southern Highlands Golf Club. Is that right? Retired to Las Vegas where he co-managed a fucking golf club from running a bank. Well, I guess that was kind of it because Otting just dicked around at the golf club and we never heard from him. No, I fucked that up. All right, he dicked around at a golf club in 2016 and then, oh yeah, because he was so fucking good at dicking around at the golf club, he was nominated for fucking Comptroller of the Currency of the United States of America on November 27, 2017. Now, who the fuck would recommend GooeyPooey, of all people, to serve as the top bank regulator in the country? Oh, I know who. That other guy, the dumber and less accomplished guy he used to work with, Steve Mnuchin, who had been confirmed as Secretary of the Treasury of the United States on February 13, 2017. So with Mnuchin and Otting back together, heading two of the U.S.'s financial regulatory agencies, you might think, I wonder if their experience in subprime lending and the objection by the CRC to their merger over CRA guidelines, I wonder if any of this will have any effect on their performance. Great question. Even though he'd been dicking around a Las Vegas golf club for a year and a half, Otting was still salty about the whole Community Reinvestment Act thing. He'd been compensated $24 million through his golden parachute by CIT, and he owned a $2 million home, but damn it, there were still poor people out there fucking over the bank, so he had to act. He told reporters immediately after he was sworn in as comptroller in December of 2017 that his first act of business would be to revise the CRA guidelines. On April 3, 2018, Mnuchin's Treasury Department issued a memo to the Office of the Comptroller, the Fed, and the FDIC that the CRA was due for an update. Otting was like, shit, man, I was literally just talking about that. But the Fed and FDIC were like, nah. In essence, every recommendation made by the Treasury aimed at some core component of the CRA's function. The absence of banks from low and moderate income communities has a few issues. One, you simply can't do banking without a physical bank. Two, if your community is historically low and moderate income, then a bank would need some kind of incentive to operate there because you can't do banking in poorer communities. After all, they have little money, which is the entire reason the CRA exists, to get fucking banks in the fucking community. 3, in the absence of a bank, you get check cashing companies that charge a fee to cash pay stubs, and you get a higher increase in the use of payday loans at criminal interest rates. We've already been over this shit, but the Treasury disagrees. Quote, however, advances in technology have reduced the need for branch-based services and have lessened community reliance upon traditional brick-and-mortar branches. End quote. If the CRA's function is to provide LMI communities with access to fair banking, it's hard to make the argument that this can be achieved without a physical bank. Also, if a CRA chartered bank has to meet the banking needs of LMI communities, then how would a bank meet those requirements if they don't have branches in those communities? Don't worry, the Treasury has thought of that too. The approach is twofold. First, instead of just counting a narrow profile of banking services that serve the LMI community, such as single-family mortgage loans and low-income housing tax credit investments, the CRA should also include letters of credit, investments, loans, and infrastructure activities, as well as alternative delivery systems. I'm going to have a lot to say about this, so let's just get through this section real quick. In other words, instead of just counting banking services that are actually provided to the LMI community, the bank should be given CRA credit for most of the banking services they provide. If this sounds a little fucky to you, it's because it is. Quote, Treasury believes that expanding the universe of CRA-eligible activities would better align the regulatory regime with the intent of the CRA statute and would benefit all of the communities served by banks, end quote. The second part of the problem of maintaining CRA compliance if you get rid of the banks in the LMI community is simple. Just let the bank use any fucking location. Quote, Treasury advocates for a framework that not only includes areas where the bank is physically located, but also LMI communities outside of where the bank has its physical footprint, and an area where the bank accepts deposits and does substantial business, end quote. If you're reading that and thinking, wait, what? Then you're reading it correctly. Wherever the bank is, just say it serves an LMI community and you're golden. And now I have something to say about alternative delivery systems. ATMs, online banking, mobile apps, and automated phone lines are all alternative delivery systems. Now just think about that for a minute. To get CRA credit, you don't even have to go to the trouble of issuing a mortgage or dealing with low-income housing. If a customer uses an app or an ATM, then that counts as improving their community. That counts as engaging the community and rebuilding the community and building up the community through banking services. Even if your bank isn't in their neighborhood, they can download the app, check their account, call the automated hotline, ask to speak to a real person, and get transferred to an answering service in the Caribbean, and that is just as good as providing a mortgage to low to moderate income borrowers. The Treasury had many more recommendations, but those are really the highlights. Get the banks out of LMI communities, get CRA credit for providing a wide range of high-end financial services to your wealthy clientele, as well as for ATMs and apps, and just say that wherever your bank is, it is serving an LMI community. You basically don't have to change a goddamn thing about the way you do business, you just get CRA accreditation without having to deal with poor people. Anyway, in April of 2018, Otting spoke at a banking conference and just flat out told bankers, remember, the people he's supposed to regulate, quote, I went through a very difficult period with some community groups that tried to change the direction of our merger, and so I have very strong viewpoints, end quote. So I guess now we've gone full fucking circle from John Jerry Hawk Jr., who in 2000 said that the OCC would use its power to ensure that banks did not discriminate or take advantage of low and moderate income borrowers, but he obviously fucking lied about it, to Joseph Otting, the new comptroller, who said, fuck it, I don't even know what discrimination is. And no, I'm not fucking with you. From Bartlett Naylor's 2018 piece in the American Prospect, he describes this, quote, at one hearing before the U.S. House Financial Services Committee, Representative Mike Capuano opened his line of questioning with Otting by attempting to establish a shared baseline that discrimination remains a serious problem. He asked Otting if he'd suffered or witnessed discrimination. Quote, I have never personally observed discrimination, Otting responded. A perplexed Capuano asked the question again, and Otting repeated the answer. Otting's surprising response baffled other members of Congress at the hearing. Representative Emanuel Cleaver asked if Otting was familiar with the white racist rally in Charlottesville, Virginia. Otting responded that he didn't watch television. Had he read about it in newspapers? Cleaver asked. Quote, I don't read a newspaper, end quote. The problem with Otting does not resolve neatly with his exit from the OCC in May of 2020. On January 14, 2020, Paulina Gonzalez Brito, executive director of the California Reinvestment Coalition, delivered written testimony, and a lot of it, before the U.S. House of Representatives Financial Services Committee, Subcommittee on Consumer Protection of Financial Institutions, in a presentation called, and I think you'll like it, quote, the Community Reinvestment Act, reviewing who wins and who loses with Comptroller Otting's proposal. Now, the U.S. House Financial Services Committee oversees the entirety of the U.S. financial services industry, everything literally to do with money business. They also oversee the Fed, the Department of Treasury, that would be Mnuchin, and the Securities and Exchange Commission, among others. Gonzalez-Brito's extensive repudiation of Otting's proposal for CRA rule changes was, just like Gloria Waldron's testimony on subprime mortgages 20 years earlier, an in-depth look at how the policies would directly and negatively impact the people in her community. It was an intimate appraisal of CRA shortcomings that could be rectified with careful preparation and, sweet words to an economist's ears, rigorous data analysis. The testimony also made clear that Otting's proposal had giant fucking loopholes so fucking large that they might have been deliberate. First, the CRA's rules are typically a joint effort, with the FDIC and the Fed weighing in equally with the OCC on guidelines and rulings, and Otting chose to move forward with his CRA proposal without input from the Fed and the FDIC, and the Fed was cool with that. Even when the Fed offered their own input, Otting was like, nah, we oversee 70% of CRE institutions anyway, so fuck off. And the Fed was like, fine, whatever, we'll fuck off. Gonzalez-Brito made an apt comparison with the subprime lending crisis. She contended that the Office of Thrift Supervision, OTS, enticed financial institutions to the OTS charter by selling its preemption or government protection, which, when OTS regulated banks such as Washington Mutual, World Savings, and also IndyMac failed, that supercharged the financial crisis. See OneWest cranking out of foreclosures. Gonzalez-Brito called this, cleverly, regulatory arbitrage. Now, arbitrage is taking advantage of price differences between markets. You take an asset from a low-value market and sell it at a higher price in a higher-value market. Therefore, regulatory arbitrage would be the practice of choosing a regulator with lower standards. It should be obvious enough that choosing your own regulator invites the opportunity for less regulation. Yeah, that sounds right. Otting's proposal expanded CRA-credited services, which sounds good on the surface, but remember that the CRA was devised specifically to help LMI communities, and a bank's CRA accreditation is derived from its impact on LMI communities. If you expanded CRA activity to include loans made to anyone and increase the dollar value of the loans that count toward CRA credit, then your incentive to provide services to actual low and moderate income communities vanishes. After all, you could just as easily entice middle and high income borrowers and large businesses who are less likely to default, all the while not serving the poor people in the community. Okay, maybe it is kind of a stretch to just assume a bank would stop loaning to LMI communities and that banks would opt for less regulation. If you want to be that naive, let's go with it, sure. But Otting's proposal also removed the requirement that banks actually put bank branches in low and moderate income neighborhoods. Otting's proposal, and this is a fun fact when you consider Otting's complete obliviousness to discrimination because he's never watched television or read a newspaper, but under the new guidelines, the Office of the Comptroller of the Currency would not double downgrade CRA ratings for illegal or discriminatory credit practices. This would be actual malice and not mistakes, and they narrowed the scope of discrimination worthy of downgrading in general. There are a lot of shitty things in Otting's proposal, but one change is especially irksome. Otting's proposal offered CRA credit on top of tax credits for displacing the poor people the CRA is supposed to help. Displacement means pushing them out of their neighborhoods. This can also be referred to as gentrification or urban renewal. The Tax Cut and Jobs Act of 2017, see also How You Fuck the Poor and Make Them Like It, introduced a new thing, a totally new thing that never before existed, the Opportunity Zone. But let's start with urban renewal. This was a policy enacted by the Housing Act of 1949 that gave cities funding to clean up their blighted neighborhoods. These just happened to be the same neighborhoods that had been redlined in the 1930s, which meant that if you give a city a few $1 million, they can buy up neighborhoods, bulldoze all the houses and buildings that have decayed because no one could get loans, and you could push the poor people out of the way to make room for wealthy white people. Chicago's Hyde Park is the perfect example. It's an extreme form of gentrification. Now, gentrification does the same thing as urban renewal, but is driven by individuals and not the government. Wealthy people buying cheap homes in low and moderate income neighborhoods, improving them, and attracting more higher income buyers to move in and eventually displace all the poor people. The Tax Cut and Jobs Act of 2017, or the TCJA, Well, what to say about this other than, all right, I'll just focus on one, it created the Opportunity Zone, which is a totally brand new thing that never existed, and two, it permanently cut corporate tax rates by 14%. Let's talk about Opportunity Zones. This is, again, a totally brand new thing that was, okay, actually, it was just urban renewal with a different name. I mean, what do you renew in an urban neighborhood? Opportunity zones. So, yeah. If you think I'm being alarmist about opportunity zones, the TCJA provides capital gains tax incentives on such things as sports stadiums, self-storage facilities, and luxury housing. Now, sports stadiums and self-storage facilities lower home values, and luxury housing is obviously priced out of the reach of poor people. So either way, you're really fucking up poor people with the TCJA. Make no mistake, the CRC and its executive director do not fuck about. Even though Gonzalez Brito came armed with a comprehensive testimony, the CRC was still reviewing Otting's proposal as she was delivering her testimony. And, in case you were wondering, yes, Gonzalez Brito's testimony included GooeyPooey69 at yahoo.com. She also took direct aim at Otting. Quote, "We are not surprised by this proposal, given OCC leadership's hostility to the CRA." She actually made several comments against Otting. Quote, "We are not surprised by this proposal given OCC leadership's hostility to community groups and the public input process." Okay, she actually made 3 direct comments towards Otting. Quote, "Taken as a whole, the comptroller's words and deeds suggest that community groups and members of the public with a differing viewpoint from the comptroller will not be given fair consideration by this OCC." End quote. How did all this play out? Well, 4 months after the House Banking Committee hearing, May 20th, 2020, the OCC announced it had finalized the changes to the CRA rules with neither the FDIC nor the Fed offering input or support. And then, the very next day, May 21st, 2020, Joseph Otting announced he would be resigning from the comptroller position, resigning from comptroller back to dicking around on a golf course. Mission accomplished. You might be wondering about the Fed and FDIC. Why weren't they obsessed with overhauling CRA guidelines? Because there was a fucking pandemic. The confluence of shitty things that happen in the pursuit of concentrated wealth and power must still contend with the churning of the world. In the case of global wealth, the World Economic Forum saw the need for fundamental change, launching the, quote, Great Reset initiative due to the suddenly apparent problems that had manifested in global climate, healthcare, and inequality. That doesn't mean they do a single goddamn meaningful thing. Those are just the things they chose to talk about. Treasury Secretary Mnuchin, forced to do his fucking job thanks to the poor timing of a pandemic, flailed. He reasoned that a $600 stimulus payment would boost the economy because it would give people oodles of money to dump back into the economy rather than, say, boosting or extending unemployment benefits or something else useful. No, rather than push for the 25 million out-of-work Americans and their families or the 13.9 million workers unable to apply for unemployment, Mnuchin was fucking up the first round of stimulus payments that delivered billions to airlines and that, quote, ran into a lot of issues such as accidentally doubling up loans to businesses. He was also trying to figure out a bailout for oil companies, attempting to coordinate with banks and the Fed to ensure that struggling oil companies with poor credit could get taxpayer loans to stay afloat. The Fed, it should be noted here, was authorized $4 trillion to issue to corporations. Just saying. So after a bonkers 2020, with Mnuchin using every single synonym for bailout without ever actually using the word, with Otting having gotten his way with the OCC before fucking off, with the president who, and this cannot be understated, seemed legitimately jealous of all the attention a pandemic was getting, I think we were all kind of left with this feeling of hope for 2021. After all, even if you didn't know the entire history of why Mnuchin's weird face kept popping up and why it seemed like he knew what he was doing but at the same time seemed like a clueless tool, it was quite obvious that he did not have any interest in you, me, and all the people we know. In fact, it kind of seemed that he just didn't care that any of us existed and needed the very thing he was in charge of, the thing that he obviously had negotiating powers over, the power of persuasion to push money out of the Fed and into oil companies with bad credit, even though, if they had been humans with bad credit, he would have foreclosed on them. And even if you never heard the name Joseph Otting before you read this section, you saw the consequences of decades of systemic racism, one that used to be out in the open, written in the Realtor's Code of Ethics, that cemented poverty in place for generations, the type of racism that mutates from out in the open to subtleties so obscure you can plausibly deny they exist, hence why Bloomberg can casually bring up redlining and dismiss the CRA, and why a New York Times writer can say, hey, Bloomberg is right about redlining, and also, man was acorn toxic. It's the kind of mutation that doesn't stop. It goes from plausible deniability to implausible deniability, to such a statement as Otting's, that he didn't watch television or read the news, so he therefore did not have any practical understanding of the concept of discrimination. And if you had been stuck in your home for months on end, watching the leaders of this country flail in their positions of power, struggling to figure out how exactly we were struggling due to their incompetence, watching protests erupt in nearly every major city across the United States against police brutality, another outcome of redlining and structured poverty, then you, too, would probably look at Andrew Left of Citron or StockLemon.com, a hedge fund manager making a bet on a failing company in the middle of an unrestrained pandemic, and think, this fucker is going to make bank, and he just told us all about it. And then, encouraged by an online group you joined for fun because you were bored during the pandemic and decided to get into the stock market, you would probably view the prospect of watching a hedge fund manager, the same kind who, in spite of gross incompetence and massive failures, would win no matter what. You decided to go all in on GameStop just to see what would happen, and then you saw what happened, and it was fucking hilarious. But then when you saw coordinated efforts to halt trading in an attempt to cool the market, you realized that outside of the hilarity there was serious, embedded disdain for the collective power of the people. And you thought I forgot about GameStop. This was episode 5, chapter 4 of Unfuck the Poor. In case you forgot the intro to this chapter.
And then Louise Linton, Steve Mnuchin's wife, lashed out hardcore at the person who criticized her, saying, adorable, do you think the U.S. government paid for our honeymoon or personal travel? Have you given more to the economy than me and my husband, either as an individual earner in taxes or in self-sacrifice to your country? I'm pretty sure we paid more taxes toward our day trip than you did.
I just want to editorialize real quick. Keep in mind that the wife of the man whose bank venture netted $2.42 billion in FDIC refunds flaunted her wealth while claiming she and her husband sacrificed so much for this country in terms of work and taxes or whatever the fuck else she was talking about. We don't really give a shit about CNN or mainstream news, it's all bullshit, but for those listening who may think that talking about luxury name brands as a major news story is vapid or inane, I'd like to counter that by saying the entire situation perfectly encapsulates the fever dream reality the super wealthy occupied, that in spite of the 10 million foreclosures during the 2008 financial meltdown, the lingering consequences still affect millions, tens of millions of Americans who have lost financial security in the decades since the meltdown, while people like Mnuchin cannibalized the very same Americans, calling them out on flaunting their wealth. So Mnuchin and his wife and Joseph Otting can all go fuck themselves with the CDO. They have no idea what life is like for 99% of Americans, let alone the global poor, and they're happy about it. The next episode of Unfuck the Poor is a brief respite from the longer episodes. It's an intermission with a brief summary of some topics already discussed. As always, check out the full-length PDF of Unfuck the Poor along with supplemental materials at askaleftist.com, and thank you again for listening.